Good morning, everybody, and welcome to our latest virtual roundtable brought to you by Bridging and Commercial and kindly sponsored by Together. Thank you all for joining. My name is Andreea Dulgheru. I am the Deputy Editor for Print at Medianett Publishing, responsible for two main print publications, Bridging and Commercial Magazine and Buy to Let Insider Magazine. Today's discussion will be focused on all the alternative uses available for bridging finance. This type of funding has often been used for traditional chain breaks. However, lately we have seen more and more borrowers opt for bridging finance to help with other cases such as refurbishment projects and development exits. We have gathered today 5 top experts to discuss what the most popular alternative uses for bridging finance are and why this type of finance might be the right solution for these deals. We'll also be talking about how borrower profiles have changed over the past 12 months and what brokers and borrowers should look out for when selecting a lender for more complex requirements. Before we dive into this discussion, I would like to invite our lovely panelists to introduce themselves, starting with Tanya.
Hello, everybody. I'm Tanya Elmaz, Director of Intermediary Sales at Together. So lots of people start their introductions by saying, I've got 20 years experience in the business. Obviously, you're thinking I'm not old enough to have 20 years, but it's true. 20 years experience in specialists. So I started my journey at Mortgage Express, Bradford and Bingley. And for those of you that had cheap mortgages on Mortgage Express, you'll be smiling into yourself. I did 8 years there. So that was a lot of buy-to-let experience. And then I moved on to bridging. So I've always been in specialist lending. I've always had that approach where I'm working for a lender that wants to lend and lends outside of the box and does a bit of a bespoke solution. So I'm very much a can-do problem solver type of person. And if you've read anything that I've written before, I'm a bit of a rule breaker as well sometimes, because looking outside of the box is sometimes what it takes in specialist lending. I love my job and I love talking about bridging. So hopefully I won't overspeak anybody today, but that's just a little warning. That's me.
Amazing. Laura, you want to go next?
Yes, of course. Morning, everyone. My name is Laura Toke. I am a Relationship Director at SPF Private Clients. SPF is an award-winning mortgage brokerage which has 25 years experience. So we were established in 1998, primarily as a mortgage broker for the estate agency Savills. We've diversified over the years. So I work within a specialist team that just advises on bridging and development finance. And we do very large volumes of business. So we're well positioned to kind of advise on that area. We tend to do a lot of regulated business because of our ties with estate agencies, but we can advise on any type of bridging transaction, whether that be bridging against land, development and commercial mortgages as well. I started in the industry in 2014 at a mortgage broker called Ennis, and I've always advised on bridging and development loans. So I'm excited today just to have a chat with other brokers, just to kind of touch base on how the market's been over the last 9 to 12 months. I think it's been very turbulent. So looking forward to getting stuck in, and thank you so much, Medianett and Together, for hosting.
Perfect. Tom?
Yeah, morning, everyone. Tom Frank, Ice Cube Property Finance. My background's in property, went into the sector in 2000 out of university, set up my own company in 2006, advising across the property spectrum, really looking at planning advice, site assembly, working with a lot of developers, and at that point working with a lot of other brokers. And then in 2017 set up our own brokerage, specialising really on that developer client and around the life cycle of their projects, from acquisition and bridging through development and then through to their exits. Thank you.
Perfect. Joe?
Hi, so I'm Joe Aston. I'm the Sales and Commercial Director at Aria Finance. So Aria, the brand, is relatively new, but it's built on the back of 2 businesses with a combined 40 years experience in the sector. So that was Vantage Finance and Enterprise Finance. The merge that happened last year has meant that we're actually, by rights, one of the largest specialist brokerages in the UK. And a big part of that is bridging. So we're well placed to sort of comment on these sorts of things and stay close to the market and some of the movements, alongside my responsibilities within sales and operationally running the business, I actually run a pipeline as well, typically higher net worth or more complex transactions, and that includes bridging, commercial and buy-to-let. So hopefully some good discussion to be had today.
Perfect. And last but not least, John.
Thank you very much, Andrea. Good morning, everybody, and thank you very much for inviting me on this roundtable today. I'm the Managing Director of Fluent Bridging. The Fluent Money Group, under which we sit, has long been established now, established itself as a secured loan brokerage, grew very quickly. It's now the largest secured loan brokerage in the UK. Excuse me. It's grown by acquisition partly. I bought a mortgage and a buy-to-let brokerage 6 years ago now, and it's also grown by bringing in people like myself. I joined the group 2 years ago to bring Fluent Bridging, imaginative title, out of the ground, and get that as a trading business as part of the group. So we're 2 years in now and 15 people strong. My background has been banking, finance, and property finance for 35 years. Yeah, kind of got all the battle scars, got all the wounds, not seen it all. We've never seen it all, but yeah, I'm up there, I reckon. So life's good here. We're growing steadily, and bridging is such a vibrant, diverse, and interesting market. I'm looking forward to hearing the thoughts of the other guys on the call today.
Amazing. Thank you so much. So I guess we can just dive into the conversation. Before we do that, I'm going to launch a quick poll to see what everybody's experience has been on what the most popular alternative uses for bridging finance has been in the last 12 months, which is coincidentally the first question I was going to ask you. Tanya, how have the most popular uses for bridging finance outside of the traditional chain break changed over the past 12 months?
Well, the past 12 months, specifically the last 9 months, have seen a lot of uncertainty in interest rates. We thought we were nearly over that, didn't we, until last week? And then the volatility is there again. So that uncertainty in interest rates has driven and changed people using bridge finance. Chain breaks is still up there, but mortgage delays is also another reason. But the most popular uses for bridge remain to be certainty of funds where people are not certain what interest rates are going to be doing. Refurb is still a very popular reason for taking out a bridge loan, and that could be to develop space in a property, convert a garage. It could be to make it more eco-friendly. Business loans are another reason why people have been using bridging finance. Obviously, it's efficient, it's speedy, and it's easy. So the popular uses for bridge loans have changed over the last 12 months, but we've still seen all the same type of reasons, but what we've seen is a bit of a shift. But chain break is still up there, along with mortgage delays, refurbs, auction purchases as well is another one. Auctions have changed a lot over the last probably 3 years. So sometime after the pandemic or during the pandemic, a lot of auctions switched to online, and that gave accessibility to a whole different type of bridge purchaser, bridge borrower. So those are the main changes that I've seen.
Mm-hmm. What about everybody else? What have you guys seen over the last 12 months?
I agree with that. I think we still see, I think refurbishment is a really big one for us. And I think the change maybe is in the scale in refurbishment. That's probably where I would say the landscape has moved a little bit. I think outside of chain break, bridging used to be for your more experienced developers who were proactively building high yield portfolios by upscaling properties. Whereas I think now your passive landlords are starting to clue up to that, and you go to trade shows that have direct borrower audiences. They're always looking for a way to maximise yield, and I think the best way of doing that now is single dwelling to a HMO or buying something under market value or at auction with the intention of adding value and adding rental value to it. So I think it's the borrowers that have changed more, which has grown, than the product use in that refurbishment space for me.
Mm-hmm.
Yeah,
just to endorse what Joe said there. We've seen people not afraid to take on fairly sizable projects. Actually, we've gone past that just putting a conservatory on or a single story extension. People with limited or no experience at all are quite prepared to take on some sizable projects, and I think that coupled with the fact that build costs have literally gone through the ceiling. It's moved from maybe high value secured loans to low value bridging loans. It's kind of tipped over to where a loan can no longer meet that, or a client's savings. So we've seen a much larger increase in people wanting to borrow, let's say 50, 60, 70,000 pounds. So it's out of that loan trajectory, but it's right in the bridging loan market. And that's being driven by the projects are getting slightly bigger, but also the build costs. And I'm experiencing this myself at the moment, 50, 60% up on what they were 4 years ago, no doubt about it.
Yeah,
I think John makes a good point on the build costs. We've seen almost the other end coming down, in that the traditional ground up developers are looking at more refurb-based products because there's more certainty of costs.
Mm.
The bulk of the buildings there, yes, there's movement in bathrooms, kitchens, etc., but not to the same extent as steelwork and concrete and labour. So we've seen people moving almost down the spectrum, and if everyone else is seeing people moving up the spectrum, then it's no big surprise that refurbishments become a big part of bridging. We've also seen a lot of people repositioning assets. So we've done a lot of stuff with retail in York, where retail, as we know across the boards, changed, but there's still some great buildings in great locations, but trying to deal with a development funder or similar to reposition a vacant TK Maxx, to name one that we did recently, with a view to turning it into a leisure facility, is a big ask. Whereas on the bridging side, there's more scope for taking that broader brush view.
Mm-hmm. Laura, what has been your experience with this?
I would agree with all of the above. I think we've seen an increase in commercial purchases where clients might need to complete quickly, but commercial term lenders are taking a minimum of 4 months at the moment. So if there's any requirement for speed, they're going to have to use bridging for the acquisition, and then we can refinance with a term lender. Or it may be that the client needs to get 12 months accounts under their belt before they can refinance. I think, again, agree with auction. We've definitely seen a rise in popularity in auctions since the pandemic. Since they were online, it's just opened up such a wider audience, and I think clients are starting to realise that they can save not only on the purchase price if they buy at auction, but also the stamp duty as well. So we're seeing, we partner with a lot of the major auction houses, and auction just continues to be incredibly popular. Just to touch on the build cost side and the development projects, we are seeing a rise in development exit loans, just because sales periods are longer for new build now. Obviously, we don't have Help to Buy anymore, which massively stimulates sales on that side. And not only that, build times are taking longer as well, just rising costs in materials and more difficult to find labour. So we are doing a lot of development exits as well, and I'd say those are the kind of main areas we're seeing.
Mm-hmm. Yeah, I think refurbishment seems to be a top contender at the moment in terms of the poll. 56% agree with this, and refurbishment being the top choice. So really interesting to see. On the back of this, how have borrower profiles and the reasons for applying for bridging finance evolved over this year?
I could kick off if you want. I think we've seen what we've kind of touched on already. Those borrowers that are not sure where they want to place themselves with interest rates, and so wanting to perhaps bide their time. So we've seen a little bit of that. Those types of borrowers who want to bridge first so that they can wait for a more opportune moment to decide how they're going to move forward with their interest rates. We've seen more mainstream borrowers as well. So, every year bridging becomes more popular, and we speak about it more, and but it's always remained specialist, hasn't it? But I do think that, I think it's from the pandemic somewhat, and every time there is some sort of economic turbulence, specialist lending gets a massive boost, doesn't it? I think the last 3 years have been a huge boost for bridging, and we see that with the continued rise in applications and completions and the size of our market. But I think even more so over the last 8 to 9 months, we've seen a change in mainstream borrowers look to bridging where they might not have before. So that opens up a different type of avenue. We can't really avoid the fact that affordability is not as easy as it was as well. So maybe we've taken for granted how easy retained interest is on a bridge loan. For those of us that are in bridging finance, it's not always the way that an applicant will want to service a loan. So it's easy to retain or roll up that interest. But more so now, that's more of an important requirement in finance now with regards to affordability. So that's really what I think for change of borrower profiles.
Yeah, I think to add my little bit in here, I think that smaller investors who have typically, bought property, spent 20, 25, 30,000 on them and flip them on for them. There's lots of those around the UK. They've been really squeezed this last 18 months, keep going back to these build costs. But if you add on 15, 20% and you're working out your return on investment, it's made those smaller projects less attractive. So the temptation is to dive into an auction, for example, and it starts to feed itself then. You dive into an auction because you look to get something 20, 25,000 pounds behind market value or snap up a bargain that then absorbs your higher build costs and enables you to complete the project and flip it on for that return you could get probably 3-4 years ago. So it is kind of feeding itself at the moment, and that auction bit, I know Tanya's already mentioned it, but that is a busy area at the moment, and I think that's part of the reason why it's okay. Well, my build costs are a lot higher. I can't do a lot about that, so I'll turn my attention to what I'm actually acquiring the project for. Can I get it 15, 20, 25,000 pounds less expensive, and all of a sudden I've absorbed the extra bill costs?
Yeah.
I think at both ends of the market, the borrowing profile's changing as well, because we're seeing, expanding on the point I made earlier about your new borrowers into bridging, actually you've got really experienced developers at the big end, which sort of furthers John's point here, realizing that PD schemes and actually developments don't always look like ground up plot of land for new houses. Actually, you pick up some really good office stock, some good commercial stock now, which can act as city centre apartments. And that's an easier transaction and an easier project to complete and to work through on a bridging loan. It's a bit cleaner. There's less emphasis on, drawdowns or a monitoring surveyor, some less costs attached to just see what it looks like up front and go for it. So we've seen at both ends is where I think we've seen the change. We've seen your passive borrowers in the UK dip their toe into bridging and discover it, but at the same time your really experienced movers in the professional side of the market are utilizing bridging as a bigger friend to them maybe than it was previously. And I think it's a great means to an end, right? Bridging is such an agile product and can be used with so many different projects that I think borrowers would be fools not to consider it and to look at the cost and look at the impact on their earnings at the end if they're doing a larger scale refurbishment project.
I think I would agree, Joe. I think as well, those reasons are very common, but I think as well we're just seeing bridging become so much more of a mainstream product in terms of the type of borrowers which would actually consider it. Because if you look at the cost gap between buy-to-let mortgages and bridging, it's ever narrowing. So obviously last year after the mini budget we had a lot of turmoil within the mortgage markets, interest rates very volatile. Bridging remained quite stable. Yes, the lenders did have to increase their rates, but it was marginal compared to the increase in mortgage rates. So we're seeing now, if rates start at 0.58% per month, it's not very different from a limited company buy-to-let product, but it has no early repayment charges and it's a lot more flexible. I think one of the main areas that we're seeing, which is a massive change for our type of bridging customer, is just a buy-to-let investor who may have bought a property off plan in 2022 or last year, now not able to complete with that buy-to-let product that they were originally going to use because of stress tests, which have gone up by 65%. Yes, rents have increased, but they haven't increased at the same rate that mortgage rates have, and the ICR test is very hard now for buy-to-let investors to meet, so they might not be able to get 75%. Therefore, they're having to use a bridging loan to complete and just sell the property instead of taking a buy-to-let mortgage, or they might use the bridging just to wait to see what happens with rates, to just enable them a bit more time to find a more long-term solution. So I think that's the main way that we've seen our clients changing, is they're just standard sort of buy-to-let investors now considering bridging.
Yeah, that's a really interesting point that you made there, Laura, about buy-to-let landlords looking for bridging finance to help them out in this tough situation, because we've seen a lot of products being pulled, a lot of volatility in terms of rates. I'm curious, over the past 12 months, what would you say the increase in the number of buy-to-let landlords that have opted for bridging finance is? How much of an increase have you seen?
I think that's probably the biggest growth market. Some purposefully, they want bridging, again, to maximize yield, take out more money, upscale the property, but some are forced into it. So actually it alludes really nicely to Laura's point. We're seeing a lot more re-bridging, and bridging a bridge is harder, right? Because it means ultimately whatever the original exit strategy was has failed for whatever reason that is, and previously really frowned upon, still in a lot of circles frowned upon. But actually I think lenders are discovering a new layer of leniency and common sense that says actually this market, last year, if you look at January last year to December and even to now, it's a completely different market. People that took out bridging loans in good faith with solid plans, good experience, clean borrowers that haven't been able to deliver in the way they normally would and need more time. Actually, I think lenders are being a little bit more lenient with them and taking them on as good debt, as new good debt, backing them. So the rise of the rebridge has meant there are more buy-to-let landlords in this market, maybe not by their first choice, but hopefully they'll see the benefits, understand how that product works and how it can benefit them in the future as well. It's why it's so important to work with good bridging lenders. It's a crowded market still, with some really good outcomes there and some not so good. Using the right lenders that understand that and willing to take a good common sense, empathetic view, I think is really important.
Tanya, from a lender's point of view, have you seen a lot more buy-to-let landlords apply for bridging finance over the past 12 months? How much of an increase?
Yeah, we have. I can't quantify the increases specifically in numbers, but yeah, to Joe's point, we have seen an increase. It's those people that can't pass the ICR test. They had a model that was right for 3 or 4% or even less. It's those landlords that have got to change their model as well. Perhaps they were going to look at a straightforward buy-to-let but want to get more yield, and so looking at a HMO option or different types of options. So we've certainly seen those type of landlords look to bridging first to enable them to change the projects that they're going to take on. In some instances, those landlords have had to cross-charge with other properties to actually continue with their projects. It's not always a case of finding an exact solution for the buy-to-let landlord with bridging, but the good thing that lots of bridging lenders do, obviously specifically at Together, we can build bespoke solutions, and often we will say to brokers, and I'm sure you'll all agree, well, we can do it like this, but we can also do it like that. There's always a different way of looking at things, and cross-charging with bridging and second charge bridging is also an option that's helped in these scenarios, because where you've got a model that fits and then interest rates have changed and it doesn't, you do have to have a plan B, sometimes a plan C. You do have to broaden the way you look at things. So that means, to Joe's point, lenders have started to look at things a little bit differently. At Together we have a rule book, but we call that our guidance, so we can always look outside of the scenario. And I think, like Joe said, scenarios are different and people are looking at things in a different way, because we have to be realistic with how we support borrowers. A good borrower is still a good borrower in a sense that if you can't achieve the numbers that you need to, plans can move either side to accommodate that. But certainly cross-charging is another area that has been growing with Together.
Yeah, I think just to finally add my little bit to this part of the discussion, just to endorse what everybody said, really, I think when you're a landlord or a property investor in a climate of almost zero interest rates, the business model with respect to everybody who does it is not a difficult one. It's fairly one-dimensional. You buy cheap, your interest rates are cheap, there's high demand for the product, you gear up. That's it, really. And as Tanya and Joe both just said, having to Tanya use the word broaden there, you do now. That model is fractured, really, because of the high cost of borrowing in that sector. So it's a case of stepping back and do we cross-collateralize? How do we do it? Do we borrow someone short term? So there's a lot more to think about now as a landlord and developer, and that's where a sensible lender who can think, as Tanya says, think outside the box, and a good broker as well who can sit them down and make them fully aware of all the options rather than just saying, here's your buy-to-let mortgage, away you go. And that makes it really challenging and also very, very interesting, and that's must be a direct driver with what everybody's seeing on this call at the moment, which is higher demand for bridging loans.
Yeah, I'd have to agree with that, John. It's so interesting what you say, good lender and good broker. It's that combination, isn't it? Because in this sort of time, you need experience, don't you? You need to be able to navigate your way. You need to be realistic with borrowers, because they will come to you with a plan, and that you as a broker will be able to see, well, that plan that's not going to work, but we can do it like this. So it's that experience of yourselves as good brokers, experience of lenders. Those types of things are really important, that we've been through turbulent times before or interesting times before, but that ability to be able to problem solve and to move solutions out of the actual guidelines is so important for brokers. I'm so glad you said that, John, because it is a partnership, isn't it? Because
absolutely,
we have bridging brokers, good bridging brokers are so important to be able to structure a case in a way that it makes sense for the borrower and for the lender as well. So I think that's a really good point, John.
Yeah, that actually ties in really nicely with my next question, which was going to be about the key factors that borrowers should look out for when selecting a bridging finance broker and a lender. And I think both John and Tanya, you mentioned all the key factors. I'm actually curious to see what everybody else thinks. Tom, what would you say are the main points that a borrower should look out for when selecting a bridging finance broker and a lender?
Lender-wise, probably slightly easier to answer first. I think people now know a lot of the pitfalls with bridging that they didn't know historically. Looking at the term, not looking at the best case scenario of everything, which is most clients' first port of call. What does happen if you hit your 12-month term? What are the results? How open are the lender going to be to adjusting the term, or just what are the costs involved in that? And that's not something necessarily that clients gave a second thought to before what we've seen over the last few years. And that probably leads on to selecting the right broker as well, understanding the market and all the different. On one dimension, all bridging lenders are very similar in terms of their USPs that they promote. We've all laughed at one time or another, I'm sure, about speed, service, etc. Everyone used to say the same thing. Now those tiny nuances of what happens at the end of the term, what are the interest rates doing? Are they fixed? Are they floating? Are they somewhere in between? How open are they going to be? And the client's never going to know that information. So us as an information point have probably become much more important than we have been in the past.
I would just like to lead on from what Tom said. I really agree with all of that. I think that's very important. I think from our perspective as a broker, what we look for in a lender is we're looking a lot more in detail at their funding model. Do they have different pots of funding that they can utilise? Because with the more complex scenarios, often they may need to go outside of criteria. And if they just have institutional funding lines, then they may have covenants in there that prevent them from doing certain things, automated valuations, for example. So, and AVM is not always going to be appropriate, but sometimes it is. So I think the funding model is so important. Also, a lender that's well capitalized, you don't want to get to the dev completion and, you know, the funds aren't available because it might be crowdfunded peer-to-peer. We tend to be a bit wary of those type of funding models. And I think just a lender that you've tried and tested in the past is probably one of the most important things for a complex scenario, so that you're not, you know, trying a new lender, letting a borrower down, and how they are on default as well. If you do come to the end of the term, are they able to give you a 6-month extension and work alongside the borrower, or are you going to be hit with hefty fees, which ultimately does reflect back on the broker who put them with that lender. I think from a broker's perspective, we need to be asking much more probing questions at the outset regarding, you know, the exit route, because obviously it is a different market from what it was 12 months ago. So we need to be looking at, you know, the sales periods. We also need to be looking at a lot more credit files now, because clients do have more adverse credit. Obviously we have a cost of living crisis and people are falling behind on payments, etc. So just need to ensure that it's responsible lending. And I think if the broker asks these questions up front, they can present it to the lender initially, so there's not going to be issues down the line with the lender not being fully in the loop with the situation. And I think that's what's really needed with the more complex bridging scenarios.
I think from my perspective, don't forget, guys, we've got a huge regulatory change in consumer duty that is going to be, for me, one of the most positive impacts on bridging finance that we've had for many, many years. It's going to move the conversation away from margin only. And as Tom and Laura have both alluded to there, it is so important, both with brokers and lenders, and consumer duty affects both in just the same way. There should now be an arrow straight line for a consumer to make a completely informed choice as to which broker they should use and why, and also which lender they should use and which product they should use. Consumer duty for me is going to be a great thing for this industry. Joe's already mentioned there's still some rough edges on this industry from time to time that we see popping up on LinkedIn. I think consumer duty, maybe not the silver bullet, but I think it will drive huge behavioural change from both intermediaries and lenders alike. And I think that ultimately is good for the consumer.
Yeah, I agree with that.
Moving on, when it comes to alternative uses for bridging finance, oftentimes these are more complex cases compared to your traditional chain break. What exactly are the differences in assessing these types of deals that aren't used for traditional chain breaks?
Sorry, John, go ahead.
No, carry on, Tom, please.
I think from a lot of our perspective and where our clients sit, the complexities lie in the simplistically the complexities of the project. So we do a lot of stuff that involves planning game. And again, going back to the previous question, for the broker and the lender to understand planning to a good level and be able to assess how realistic that planning application is, makes the exit much more accessible. In the olden days were very much, it was tick a box, planning game, that's the exit. Now I think it's even more important to look at how likely is that planning, and what, if that planning doesn't happen, is there still an exit, or is it really just down to 12 people in a room putting their hands up at the right time, otherwise you're in a mess. And I think whatever sector it is, planning happens to be the bit that we do a lot of work on, but understanding the nuances of the project far more important than it's ever been. Probably always should have been important, but because we're in a rising market and it was very easy, there's probably been a lot of bridging that's just washed through without necessarily the broker and quite often the lender really understanding the finer detail of the project.
That's such a nice broad brushstroke you can apply to all of it as well, to any complex scenario, because in a nutshell, it is just greater due diligence on the exit. There's not really any difference, right? Whatever's going on in the middle, the bridging loan is a means to an end, and the end is generally sale or retain. And actually, whatever that looks like, we have to make sure that, and it relates to the question previously, how do you pick the right broker? How do you pick the right lender? The right broker asks that question and puts real weight behind, are we getting out okay here within 12 months, whatever the term is? and the right lender won't lend unless they're confident that the broker has done that job. And if you get two parts that fit nicely within that transaction, I think a complex bridge is similar to a vanilla chain break bridge. It's just a different exit route that needs a different level of due diligence and a different set of eyes on it and expertise. But you want someone that puts as much weight behind it as they would if it was a chain break bridge against your own home. People treat investment property like you're living in it. I think generally you get a maybe a more trustworthy service. That feels too harsh, but I think you understand the sentiment.
Yeah, I would agree with all of that. It's so good to hear you brokers talk in this way about the exit, what happens afterwards. You know, I've said it before, having your plan B, all these things are really important to look at in complex scenario. Affordability, the future. There's no point in enabling a bridge loan that your customer can't get out of 12 months later. It's not about that, you know, it's about looking after the customer. And obviously, like you say, John, consumer duty is even more focus on that. I think choosing the lender is really important, asking the right questions, you know, understanding the challenges, being realistic with loan to values, being understanding of the entire picture is really, really important. I think we're lucky at Together, we've got term options as well. So I know we're talking about bridging, but we do even more so at the moment, you know, do consider, you know, what is the exit? You know, if it's a sale, it's probably going to be a little bit longer than it was, you know, 2 or 3 years ago. If it's a refinance, that is a moving line, isn't it? And we've seen that from last week, that just keeps on moving. You know, we often look at bridges to say, is this a term? Can we apply a term if the exit fails? You know, that we're lucky in that sense that we've got, you know, lots of different products that we can offer. But again, it's like you've all said, and I think Tom, you just said it as well. It's about brokers and lenders looking at that whole picture in a lot more than they ever did. And what happens after the bridge, you know, looking at that exit is so key.
Yeah, I agree. I think as brokers, we just have such a responsibility to do our fact finding up front. And, you know, the chain break scenarios, generally speaking, they are more straightforward. You've got a property they're purchasing, a property they're selling, and it's loan to value driven. Yes, there might be, you know, a refinance involved at some point, but those are more straightforward scenarios. And I think we need to choose a lender if we're looking at a complex scenario who offers faster decision making and can be more flexible, because ultimately we're dealing with more complex security types, and we might need the lender to take a view on the legals. They might need to be able to accept indemnities. If we're dealing with a challenger bank who just offers bridging, it may be a tick box exercise, and we just won't be able to have that conversation with them. So again, it just boils down to the broker doing their due diligence on phase one, and also putting the borrower with the correct lender who they know can take a view on certain things, and that's just what a more experienced broker does. And I think, yeah, again, exits are going to be key. Using a lender that offers life cycle lending that could potentially take out the debt does give a greater deal of security, because obviously they've already done their due diligence on the borrower and the asset on day one, so we have more confidence that they can get out of it. So yeah, just to kind of summarize, very much agree with what Tanya said.
Fantastic. Looking ahead to what the future might hold for the sector over the next 12 months. While it's very, very hard to predict without a crystal ball, I'm curious to know what you think the next bridging borrower trends will be over the next 12 months, or what you expect to see.
I think anyone's brave to predict this. And might change by the end of the day, is that even economists can't predict interest rates at the moment. So we'll give it a bash. But I think we've looked from all the data that we've looked at, you know, all the data that's published with bridging trends, and we can see that applications are rising quarter on quarter. The bridging loan market is growing. I think it's about 6.5 to 7 billion. So what we're going to see, well, we're going to continue to see more of that. But I think what we're going to see is a change in loan to values, perhaps a reduction in loan to values. We might see that. I think we'll see a reduction in loan sizes as well. And we might see longer terms that are required, for the reasons that we've already discussed, that sometimes 12 months, might not be enough time to get in and out of the projects that you want to be. But I think what we'll see is a continuation of growth in the market as more mainstream borrowers come into the market, as more brokers open up. Everybody recognises that bridging is a huge growth area. So we'll continue to see that, but with just some nuances in the loan to values and the loan sizes and the length of time, I think.
I think, without being pessimistic, I think we haven't seen the changes to the property market that are going to come out of the interest rate rises yet. I don't know the exact number of mortgages that are coming off fixed rates this year, but it's a big number. So we're going to have to see some effect on the property market, which I think will have two big impacts on bridging. Well, more than two probably, but specifically, we're going to see more auction sales, sadly, I think, and people looking to take advantage of those situations. And I think we'll see a lot more dev exit stuff. We've been quite lucky in not seeing a lot of that, which I say lucky. Our clients, we work in a good area. The market's been strong, still is strong at the moment. But as that cools down, those dev exits and those sales times are going to extend. And I think we're going to need some better products coming out. To me, dev exits used to be very different. Now they're basically bridges. Dev exit used to have a lot more of shared income for developers, so they could pull some profit off the table and move on to the next projects. And I'm seeing that creeping back in with a couple of lenders. But I think that's probably somewhere where I'm probably jumping ahead questions slightly, but I think there's definitely a room for a new product in the dev exit market, because it's going to be, I think we have this conversation in 6 months' time. It might have overtaken refurbishment as the top pole thing, possibly.
Laura, would you agree with this?
Yeah, I would agree. I do think we're yet to see the full economic impact of the interest rate rises, and unfortunately, as Tanya and Tom have both alluded to, I think we're going to see some potential distress in the market, more properties going through auction, for sale situations, which is going to be, great for well-capitalized investors who are looking to take advantage of those situations. But I think, with the cost of living crisis, people falling behind on payments, we will see more properties on the market in distressed circumstances. I think bridging will continue to be really popular, where buy-to-let is struggling at the moment to meet the demand. So I think we're going to see, as Tanya said, a lot more mainstream clients who wouldn't have considered bridging before utilising bridging. And I do think, we potentially do have some challenges ahead of us. But I think with the cost of bridging so close to buy-to-let at the moment, it really is just an education piece. And I can see it continuing to grow. But I'm a little bit disappointed Tanya saying lower loan to values, because one of the things I was going to ask for in a minute is higher leverage. So obviously that's probably not going to happen.
Look,
but
Laura, we can always cross charge something else. My answer to everything.
Okay, perfect. Perfect. But I think saleability is going to be at the forefront of lenders' minds, and also down valuations. At the moment, I'd say on average we are seeing a 10% haircut on each transaction to the property value. So clients are going to just have to readjust their expectations of what the property is worth, because I think surveyors are quite nervous at the moment.
Joe, what do you think will
I think one of the things that's going to help feed the bridging market is a wider coverage events like this, education for brokers who are traditionally dealing with prime residential mortgages. Actually, we're all in agreement that bridging is becoming a more mainstream product. I think if you go out onto the street and ask 10 people what's a bridging loan, you get one tell you, maybe, and maybe not every time. So I think that message comes from, yes, us in the specialist world already, but it needs to filter out then into the mainstream mortgage market and mortgage brokers who are trusted more than ever now in a difficult environment. The downfall of the mini budget in September led to mainstream coverage saying, go speak to a broker, right? It was the great silver lining, that the message was go and seek an expert's advice. I think now we have to make sure that brokers across the country are educated in the benefits of bridging. What does it look like? What does it cost? How is the payment taken? I think if you presented terms to an uneducated, through no fault of their own borrower or broker, that showed 12 months interest retained, I think people would panic. think that these products are still incredibly expensive and not feasible, not viable. Whereas when you then explain the benefits and what that means and what the month-to-month impact is on the borrower, it becomes a more viable transaction. So education for me, I think, will then drive a growth in the bridging space, because I think the product will live on when others are facing more challenges. But I think unless we are educating people properly, which is great, it's great that we're doing this. It's great that we have banks like lenders like Together who are so keen on an education piece. And I think that's a shift in the market we'll see, and hopefully we can continue to contribute towards.
Yeah, for me, very quickly, increase in first-time applicants and smaller loan sizes, which is what I see a growth area for this year. And I agree with the sentiments of the rest of the guys. And Tom, it's not pessimistic, it's realistic, as what you said. And I think that whilst this industry has got a large dose of realism with it, it will continue to thrive. We can't just charge on thinking everything's great. Every lender and every broker has to keep an eye on the wider market. And I think generally the high stakes players in this industry do it very, very well, actually. And I think it's what's meant that since September, the market's actually gone from strength to strength, is because it's realistic and it's aware of possible threats or challenges to how we might lend money going forward.
On the point that Tom mentioned earlier about the products available in the market, actually the latest EY report, which was published in the Bridging and Commercial magazine, revealed that 49% of bridging businesses are thinking about product diversification over the next 12 months. Could we see lenders create more bridging products specifically designed for these alternative uses? And if so, what would these look like?
I'd just like to say, I don't think we need any more products per se, because I think it just becomes quite confusing, and I think that bridging should be kept simple. An enhancement of criteria, I think, would be better, and just obviously to lenders clearly communicate the enhanced criteria. But I think where we struggle often is for development finance, so ground up developments under $1 million. I think that's quite an underserved part of the market, but there are developers who are looking to get started, and obviously those smaller loans would be useful. Also, more lenders operating in Scotland. I think there is a really good market in Scotland, but we still just don't have as much choice up there. So that's another area that we'd like to see. We're seeing a lot of second charges at the moment, just for a variety of purposes, raising funds for cash flow, business purposes, IHT bills. We'd like to see more lenders offering equitable charges, because it's just such a slow, drawn out process getting second charge consent from the first charge lenders. And I think also more commercial lenders lending against the commercial investment value rather than the 90-day vacant possession value, because that does sometimes just knock the deal out, and there is obviously sometimes a lease that needs to be taken into account. So I think those are things that we'd like to see. I don't know what the other guys think, but I think that's definitely what we'd like to see more of.
That sounds like a good list, Laura. I've written them all down.
Something for you to work on, Tanya.
I've written them all down, but equitable, yep, Together do that. Scotland, we cover that. Seconds, we cover that. And commercial, we don't lend always on the 90-day. So I think we're well placed for that. I think, Andreea, it's not, bridging, like Laura said, it's not about developing new products. It's about the product is there. Like Laura said, it's quite simple. A bridge can be for any legal purpose, but it can be used in so many different ways. But tying into what Joe said earlier, education, isn't it interesting that as we know bridging really well as lenders, we've been doing this 50 years. Our loan book is 6.2 billion. We're pretty well practiced at bridging, doing over 100 million a month. And still, we need to educate brokers, and new brokers still need to educate borrowers. It's that continued need to actually let people know what use is, and let people know how to spot opportunities for bridging, and let people know what solutions can be derived. Yes, sure, Laura, enhancements in criteria, bridging lenders need to continue to be agile all the time and to be looking at how they are serving. There's no point in having a product that doesn't serve your borrowers and serve your consumers, right? So as consumer needs change, lenders need to look and to make sure that they're offering matches our consumers. But I don't think we need a whole suite of brand new products. We just need to continue to educate and enhance what we've already got?
I guess it depends how you define product, doesn't it? We're all used to seeing lists of products, and I agree, more lists of trendily named products are unnecessary. So yeah, it's more about understanding the smaller nuances. Land for me is a real pain at the moment. Everyone's just got a carte blanche no on land. Whereas actually, if you can look at an individual project and assess, I know you do still do land, but generally speaking, it's a no on land. But spending 20 minutes looking at a scheme because the client's going back into planning to increase the square footage or to put an extra bedroom in the roof of every property makes it make sense, and suddenly you're washing away the issues of increased costs or mitigating the increased costs, and suddenly that land deal works. But if it's a no to land day one, you never really get to have that conversation, which I know you can have with you. So.
I'm trying to keep my mouth shut now at this point.
Well, that has been amazing. And this discussion has actually resulted in 2 questions from the audience that I would like to put forward for you guys. First one, from an anonymous attendee. While the institutionalization of the bridging market has made it more professional, has it reduced the commercial thinking of the sector due to some funding lines getting heavily involved in credit?
Yeah, is a short answer there, isn't it? I think I think you see there are some great rates on the market with some very clean vanilla off-the-shelf bridging, and criteria is criteria. It feels much more like a buy-to-let loan at times. It's just quicker in a different type of finance. I think you have to then, and the problem is those rates then take the headlines, right? So everybody wants those rates and they want those products, but actually not every case fits there, and there's not as much influence for the greatest broker, in the UK. It doesn't matter who you are, it fits or it doesn't. That's difficult because that sort of goes against everything bridging claims to be. Now it has a home, and we're seeing a lot of those loans go out and hit the market, and actually, to their credit, they are deliverable headline rates, which not every product has in the market. But yes, I think if you're looking then for what I'd call common sense lending on the bridging side, you're going out to lenders who have a mixture of institutionalized funding and private investment, or potentially their own money. And I think that's where you get much more flexibility in the ability to negotiate with senior decision makers, people with credit mandates at a high level. And that's where a good broker should be able to make an impact. But if in a really short answer, do I think institutionalized funding has made it a little bit more vanilla? Yes, I think it has.
Anyone else?
I can't answer that really.
John, what do you think about this? Would you like to have a go at this question?
Yeah, I mean, well, I'm in complete agreement. A little bit similar to Tom, really. It was a very thorough answer, and again, just leads me back to consumer duty all the time. The principle of understanding a lender from front end to back has never been as important. Not only is it a regulatory requirement, but it's driving the right behaviours. So, I think Tanya touched on it earlier. What happens if it's all well and good at the front end recommending a product or a lender, but do we know what happens at expiry of the 12 months? Is there an option to extend? If there is an option, what are the costs there? Does the margin go up? Is there a fee to do it? All these questions are ones that will hopefully weed out the headline margin grabbers on LinkedIn and various other forms of media. And those typically are the ones where there are various covenants that sat within the funding line, hiding somewhere, and it always bites the consumer. Never the broker. So we just got to be really aware of that, because it does exist, and it absolutely, it's like it's equivalent to the skipped and 100% mortgage at the moment. Great headline grabber, but let's see who in the UK has actually got one of those in the last couple of weeks. Probably nobody. It's so difficult. So I know that's a different product sector, but it's the same principle really. Got to be can you actually attain what's being put down in front of you? And if you've got a lender who hasn't got those constraints and covenants, they can think commercially, paraphrasing Tanya, out of the box, and hopefully make a sensible commercial decision on a good lending proposition.
Yeah, I would agree to that. Just quickly, it's about awareness, knowing your lender, knowing what your lender has been through, knowing your lender has gone through turbulent times, knowing how your lender reacts, knowing their funding line, understanding how they think. You can't get that in a new relationship. That's an established relationship that's going to give that to you. There's a place for these vanilla loans and vanilla rates. There's a place for them. But it's really important to know the covenants and the details behind the funding lines of lenders, so that you know what happens beyond the bridge loan, because that's the most important thing. It's about getting your borrowers out of their bridge loan. In essence, it's fairly easy to organise a bridge loan. The skill of a broker and a lender is to be able to exit in the right way to support the borrower.
I see. And the second question we've got, again from another anonymous attendee, this is on a point that Laura made earlier about which lenders brokers would tend to avoid based on potential funding issues. The person asks, how can brokers new to bridging learn about these nuances early? Is there a forum for this broker discussion?
I think that's a really good question, and I think the great thing that's come out of this discussion today is I don't think a long time ago we would even be having these conversations about a lender's funding model. As a broker at SPF, we make it our responsibility to inquire about those questions and understand how a lender is funded, because it's so important for the borrower how the transaction pans out to completion, but also, as Tanya alluded to, on redemption of the loan. So I would say, these type of forums are great, roundtables that Medianett does, obviously expos, things like that, but speak to a packager, speak to a well-established broker who is able to offer that advice. If you're new to bridging, I would always advise to speak to a packager or a master broker, because they're not necessarily going to take your client away from you. They might just be able to give you some advice. And for the first couple of bridging loans that you do, you're using someone who is very experienced in the market and has a great process of how to choose a lender. But I think it really is the education piece, and we need to have more conversations like this, so that brokers who are newer to bridging and might be specializing more in the mortgage sector, are more educated. It's just the responsibility of us as master brokers, packagers and lenders, I think.
I don't think you can get away from the fact that the best thing you can do is go and speak to the lenders. As you just said, go and sit with them. I would probably think we spend as much time with lenders as we do with clients. I'm sure everyone on the call is the same. And it is asking the question and drilling down on the answer, and seeing how much of a real answer you get, and how, and the detail behind that. Otherwise, it's not something that's easy to find and well published. Quite rightly, it's their intellectual property at the end of the day, but you do need to be in front of them and ask the question, I think.
Yeah, I agree with both of that. I think our packaging partners are so important, because you guys understand how we work, how we think, what we want, what we need. And so if you're a new potential broker wanting to understand about bridging, then to access together, a packager is the absolute right place to be. Our relationship with our packagers is a deep relationship. We make sure that our packagers understand not just our products, but they understand how we think, how we're going to structure a deal, and that they have access to decision makers. And this is really important as well. So if you're a new potential broker, you can obviously access lenders. We're happy to see you and have those conversations, but packagers are a really good source of information, because they have got so much experience with all the lenders that they can give you the right answers.
On the back of that, would you have any other advice for new brokers entering the bridging sector? What else would you encourage them to do to succeed?
Mine would be there's a fine line with this word, and I don't mean slow down, but I mean be patient in terms of getting into bed and partnering with the first lenders you meet at trade shows and see online. Again, it is a broadly unregulated market still. I think the last report I saw said there were over 300 bridging lenders in the UK. So that's a huge amount of lenders, and I think we have, regardless of our panel size, so the truth be told, is 10 11 get regular use because they're people we trust, they cover all bases, they're deliverable, and you'll see newer lenders to market. And this isn't to discredit them, because there are some fantastic new bridging lenders, and those people always break through the parapet and, you know, start to compete. But they'll lean on their service deliverability and how quickly they can work. But Tanya will be at pains to tell you that some of the big boys won't move quickly too. And actually, it's not unusual to see 3-day turnaround, 2-day turnaround case studies coming from the likes of your Togethers and their peer group in that market. So actually, utilizing the advice of established brokers early on, I think is the right move to learn who your lenders are. And if it's something that you want to do and move into and your business is going to evolve into and adapt into, then I think that's a good thing. But I think doing it right, feeding the right lenders benefits all of us. The stronger that Together and the likes proposition becomes, and the stronger their loan book becomes, the better we all do from that market. So yeah, I'm really keen to see good lenders thrive. And I think as a new broker to the space, you need to take early advice from established brokers.
Anybody else have any other advice?
I think probably try and integrate yourself in the wider professional team as well. Solicitors in particular are probably a good point of reference for the good, the bad, and the ugly of the bridging world. You know, that they're on the coalface the same as a broker is, and probably have quite a lot of weight in their opinions of how transactions have gone with various lenders and brokers.
That's great. Well, this has been an absolutely fantastic discussion. Thank you all for joining, and thank you to our lovely panelists for sharing all of these great insights.